Episode 6: Mastering Asset Allocation. The blueprint for building wealth that lasts. Why asset allocation is the engine of long-term returns. Disclaimer: this content is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before making investment decisions. We've just covered how risk management keeps you in the game. But here's the truth: what you own, and in what proportion, determines most of your returns over time. Not market timing, not stock picking, it's your asset allocation that quietly drives the majority of your wealth building success. 1. The 90% rule. What the data says. In a famous 1986 study by Brinson, Hood, and Beboer, researchers analyzed 91 large pension funds over a decade. They found that more than 90% of the variability in portfolio returns came from asset allocation decisions, not market timing or individual security selection. Follow-up studies since then have confirmed it. While stock picking and timing matter at the margins, your long-term outcome is shaped mostly by how you spread your money across major asset classes. 2. Understanding the core asset classes. Think of asset allocation like building a recipe. The ingredients are your asset classes, and the ratios you use change the flavor and risk of your portfolio. Equities, stocks, growth engine, but highest volatility. Bonds, fixed income, income source and volatility dampener. Real estate, inflation hedge, income and diversification benefits. Commodities, inflation hedge and portfolio diversifier. Cash, cash equivalents, safety net and liquidity buffer. 3. The risk-return spectrum. Every asset class sits somewhere on the risk-return curve. Over the last 50 years, U.S. stocks have returned approximately 10% annually with approximately 15% volatility. Bonds have returned approximately 5 to 6% with approximately 5 to 6% volatility. Real estate investment trusts, REITs, have returned approximately 9 to 10% with volatility similar to stocks. The key? Combining them in smart proportions can create a portfolio with similar returns but lower risk. 4. The power of correlation. Correlation measures how two assets move relative to each other. Plus one correlation equals move perfectly together. One correlation equals move exactly opposite. When you combine assets with low or negative correlation, you smooth out portfolio volatility without necessarily sacrificing returns. Example: during the 2000 to 2002 dot-com crash, U.S. stocks lost approximately 45%, but U.S. Treasury bonds rose approximately 35%. Investors with both in their portfolio saw much smaller overall drawdowns. 5. Strategic versus tactical allocation. Strategic asset allocation, your long-term, default, mix, based on goals, time horizon, and risk tolerance. Example: a 60/40 stock-bond split. Tactical asset allocation, short-term adjustments based on market conditions, valuations, or macroeconomic shifts. Most successful investors lock in a strategic allocation and only make tactical changes within strict limits, avoiding emotional overreactions. 6. Why one-size-fits-all doesn't work. Your ideal allocation depends on time horizon. Longer horizons can take on more equity exposure. Risk tolerance. How much volatility you can truly stomach without panic selling. Financial goals. Income now versus growth for later. Other assets. For example, if your job is tied to real estate, you may want less real estate in your portfolio to reduce concentration risk. Building your ideal portfolio mix. Data-backed models and real-world examples. 1. The historical performance of popular allocations. Let's start with some famous allocation models and see how they've done over time. These are inflation-adjusted, total return figures from 1973 to 2023. 100% S&P 500. Approximately 10.3% annual return, but with a 50% max drawdown. 60% stocks, 40% bonds. Approximately 8.9% return, 32% max drawdown, much smoother ride. All-weather portfolio. Ray Dalio, 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities. Approximately 8% return with only 20% max drawdown. Golden Butterfly. 20% total stock market, 20% small cap value, 20% long-term bonds, 20% short-term bonds, 20% gold, to 7.8% return with extreme stability. Key takeaway. Lower volatility often means you can stick with the plan longer, which compounds better over decades. 2. Deciding your starting point. Before choosing a model, answer 3 questions. What's my time horizon? Short-term goals lean more conservative. What volatility can I tolerate without bailing? Do I need income now or growth later? Your honest answers will determine whether you start with something aggressive like 80/20 stocks, bonds, balanced like 60/40, or defensive like 40/60. 3. Using target date funds as a benchmark. Even if you don't invest in them, target date funds can be a great reference. They automatically adjust allocations as you approach a target retirement year. More stocks when you're younger, more bonds as you get closer. For example, Target Retirement 2050 Fund, approximately 90% stocks, 10% bonds today. Target Retirement 2030 Fund, approximately 65% stocks, 35% bonds today. 4. Stress testing your allocation. Historical data is good, but stress testing makes it real. Ask, how would this allocation have performed in 2008? What about the dot-com crash or the COVID-19 sell-off? If inflation spikes to 7%, which parts of the portfolio hold value? Example, the 60/40 portfolio lost about 20% in 2008 but recovered within 2 years. 100% stocks took about 4 years to fully recover. 5. Adding inflation protection. Long-term investors should hedge against inflation erosion. Commodities tend to rise when inflation spikes. Treasury inflation-protected securities, TIPS, adjust principal based on CPI. Real estate often keeps pace with or exceeds inflation. Even 5 to 10% of your portfolio in inflation-resistant assets can help preserve purchasing power. 6. Factor investing for extra precision. Beyond broad asset classes, some investors tilt toward factors, patterns in securities that historically produced higher returns. Value, stocks trading below intrinsic worth. Momentum, stocks showing recent strong performance. Quality, companies with strong balance sheets and stable earnings. Small cap, historically higher returns, but more volatility. For example, the FAMA French 3-factor model shows small cap value stocks have outperformed the broad market over decades, though with bumpier rides. Advanced allocation strategies, going beyond the basics. 1. Global diversification. Many investors think diversification means holding U.S. stocks and bonds, but limiting yourself to one country leaves you exposed to concentrated risks. From 1970 to 2020, U.S. stocks returned approximately 10% annually. International developed stocks returned approximately 8.5%. Emerging markets returned approximately 11%, but with much higher volatility. By including global equities, you reduce dependency on one economy's fortunes. For instance, when U.S. stocks lagged in the 2000s, emerging markets significantly boosted diversified portfolios. 2. Including alternative assets. Institutional investors like pension funds and endowments often hold 20 to 30% in alternative assets such as private equity, hedge funds, infrastructure projects, real estate, direct ownership or rights. Alternatives can have low correlation with traditional assets, helping smooth returns. Example, Yale University's endowment, managed by David Swenson, attributed much of its long-term outperformance to heavy use of alternatives. 3. Dynamic rebalancing. Rebalancing is the process of bringing your allocation back to target after market movements shifted. Calendar-based, e.g., rebalance once or twice a year. Threshold-based. Rebalance whenever an asset drifts by more than, say, 5% from its target weight. Data from Vanguard shows that threshold-based rebalancing often results in slightly better risk-adjusted returns, especially in volatile markets. 4. Glide paths and lifecycle adjustments. Your allocation shouldn't stay static forever. A glide path shifts your mix gradually toward safety as you approach major goals. Aggressive in early years, more equities for growth. Balanced in mid-years. Defensive in later years, more bonds and cash for stability. The key is to avoid sudden, emotional shifts. The adjustments should be systematic and rule-based. 5. Integrating risk-parity concepts. Risk parity allocates not by dollar amount but by risk contribution. Instead of 60% stocks, 40% bonds by capital, you balance so each contributes equally to overall portfolio volatility. This often means holding more in bonds and using leverage on lower volatility assets to match risk levels. Ray Dalio's all-weather portfolio is a well-known example of risk parity principles in action. 6. Guardrails against market timing. Even advanced investors can fall into the trap of over-adjusting allocations based on short-term market noise. Guardrails help prevent this. Preset allocation bands, e.g., stocks can only range from 55%–65%. Mandatory cooling-off period before making large changes. Written rationale for any allocation shift. The behavioral side of asset allocation, staying committed through all conditions. 1. The discipline gap. Studies consistently show that investors underperform their own portfolios. Why? Because they don't stay invested in the allocation they chose. Dalbar's 2023 quantitative analysis of investor behavior found the average equity fund investor underperformed the S&P 500 by over 5% annually over the past 30 years, largely due to buying high and selling low. 2. Anchoring to recent performance. One of the biggest allocation killers is chasing whatever has done well recently. Example. In the late 1990s, tech stocks were so hot that many investors shifted heavily into them, right before the 2000 crash. Your strategic allocation is meant to protect you from exactly this kind of overconcentration. 3. Using automation to remove emotion. Automation makes it easier to stick to your plan. Automatic rebalancing through your brokerage or robo-advisor. Automatic contributions that buy across your target allocation, regardless of market mood. Dividend reinvestment so cash doesn't pile up unproductively. 4. Pre-commitment tools. The more you lock in your decisions before emotions hit, the better. Write your investment policy statement with exact allocation targets and rules. Set allocation bands, e.g., stocks must remain between 55%–65% and rebalance if crossed. Share your plan with an accountability partner or advisor. 5. Visualizing the long term. Sometimes the best behavioral hack is perspective. Look at rolling 10 or 20-year performance of diversified allocations. Review how often they actually produce losses over those long horizons, far less than short-term charts suggest. Remember that most bear markets recover within a few years, making panic selling far more damaging than enduring volatility. 6. Avoiding the "one change fixes everything" myth. Changing your allocation because of one headline, one prediction, or one expert tip is a dangerous habit. Asset allocation success comes from consistency over decades, not perfect short-term adjustments. Your asset allocation is only as good as your ability to stick to it. Master the behavioral side, and your carefully designed mix of assets will have the time it needs to work. Your action plan for asset allocation success. 1. Step-by-step allocation framework. Step 1. Define your goals and time horizon. Are you building wealth for retirement, saving for a house, funding education, or aiming for financial independence? Your time horizon will drive your mix. Step 2. Assess your risk tolerance. Honestly use both numbers, maximum percent loss you can accept, and emotion, how you've reacted to past downturns, to find your comfort zone. Step 3. Choose your core asset classes at minimum. Include equities for growth, bonds or fixed income for stability, a small allocation to inflation hedges like real estate or commodities. Step 4. Pick your allocation model. Start with a proven mix like 60/40, all-weather, or golden butterfly, then adjust to fit your profile. Step 5. Set rebalancing rules. Decide in advance, calendar-based or threshold-based. Stick to it. Step 6. Automate contributions and rebalancing. Reduce decision fatigue and emotional interference. Step 7. Review annually. Only make changes if your life situation or goals change, not just because markets are volatile. 2. Common allocation mistakes to avoid overcomplicating. Too many asset classes or micro-allocations can dilute returns and create confusion. Ignoring costs. Expense ratios and trading fees compound over time. Keep them low. Neglecting taxes. Asset location, which accounts hold which assets, matters as much as allocation itself. Chasing trends. Don't shift allocations based on headlines or hype. Failure to diversify globally. One country's economy can underperform for decades. 3. The compounding effect of consistency. The real power of asset allocation is not in perfectly predicting the future, but in consistently applying a disciplined structure across decades. Even modest improvements in stability can lead to dramatically higher ending wealth due to uninterrupted compounding. Example: a portfolio that avoids large drawdowns and stays invested can end 30 years later with 30 to 50% more wealth than a portfolio with similar returns but higher volatility. 4. Final takeaway. Markets will change, economies will shift, headlines will scream. But the foundation of a great investor isn't predicting every turn, it's building an allocation that works in most conditions, and having the discipline to stick with it. Master that, and you've unlocked one of the most reliable wealth building engines in all of investing.